Good afternoon, everybody. I'm just waiting 60 seconds for a few stragglers to join us. Won't keep you waiting very long. Should be within the next few seconds. Welcome, good afternoon, starting any moment. Please be patient, won't be long. Okay, let's make a start. I think a few people are still due to join us, but we need to get cracking. So good afternoon again, everybody. I'm Martin Sherwood. This is a 30-minute webinar, primarily on the subject of the budget, and I'm going to tell you what I think is likely to happen in the budget using the best available data and intelligence I have access to. And then at the end, in the last 5 minutes or so, I'm simply going to touch very briefly on our own products for the season and how they may be impacted by the budget and when you should be thinking of investing. Okay, so let's move on. There is a risk warning here, and I'm sure all of you are acquainted with risk warnings. It's the usual risks, so I won't spend any more time dwelling on that. Let's move on to talk about the agenda, which is, as I just said, is primarily about the pre-budget. And then we're talking at the end, just mentioning our four major products: our media fund, our leisure EIS fund, our SEI fund, which is investing in food and drink, very interesting product, and finally our business relief or business property relief product, which provides exemption from inheritance tax, which is a co-venture with Guinness Asset Management. And then Q&As from you. So please email in your questions, and my colleague will feed those to me when we get to the end. Right. So let's now talk about what's been going on here. A few key events and timelines. I think we need to go back to May of this year when we had the Tory Manifesto. Many people have forgotten all about that, but it was quite an important document. It set out what the Tories were intending for their first parliament of the new regime. I'll come to that in a second. And then we had this thing called the patient capital. It's a review which has been instigated and initiated by the Treasury. They announced way back in February that they were going to do this. There was a committee formed, some 24 people, made up of people, the great and the good of the land, I call them, but representatives from our industry, which did cause us a lot of concern. We understand the committee only met twice. We think the patient capital review is largely being driven by mandarins at the Treasury weeks, so everybody was on holiday, needless to say, so we've had to really jump on this very quickly in order to get responses in by the deadline, which was 22nd of September past. We're now in this period between the deadline for responses and the actual budget on the 22nd of November, and we're nearly halfway through that process. Various discussions are ongoing between various parties, including the EIS Association representatives and the Treasury, in an effort to get the best possible result for the industry in the budget itself. So we can speculate about what is going to happen in the budget. Will the changes be overnight changes? Will they be changes with effect from the 6th of April 2018? Will the Chancellor simply announce a consultation period? I think personally it could be all of the above. I think he is intending to make overnight changes, so I think we could definitely get announcements in the budget which would be enacted on midnight on the 22nd of November. And they could be really quite serious changes. Some of the changes might be post-dated to 6th of April 18, and some of the changes, as I say, might be subject to a consultation process. The problem with consultation processes is you don't know when they're going to end, so the consultation process could carry on for 2 months or 3 months, and Treasury could suddenly make up its mind and issue a press release, and on that day then the law changes. So it's a slightly unsatisfactory process. Moving on, the Tory Manifesto, which I mentioned just now, it didn't make any mention of venture capital trusts, which the venture capital trust industry took as a very bad sign, and I think the panic started right then and there. These, however, were singled out for special mention, and they were described as world-beating. So the EIS described in the Tory Manifesto as a world-beating scheme. So those of us in the EIS industry took that as a really good signal. However, the Patient Capital Review has set us back somewhat. So I think the VCT industry, they really got going in May, and they said, goodness, it looks as if VCTs could be for the chop, possibly. As early as November, we better get our offers out and on the streets as soon as possible. So that's what has broadly caused the VCT market being brought forward so promptly and quickly this season. Okay, so what did the Patient Capital Review look at? Well, it's there on the website, 76 pages of it for anyone to read. Its prime focus, interestingly, is on this new buzzword, which is scale-up. So it doesn't talk hardly at all about startups. It talks about scale-ups. So it's focusing on capital for businesses already up and running, but badly need further capital to develop them to their full potential. So this is what is known by patient capital. It simply means long-term capital, so it's a slightly confusing title. So the review, it considers various different things. It looks in detail at the state aid scheme. So by that we mean venture capital trusts, enterprise investment schemes, business relief, and various other somewhat minor state aid schemes. It also looked in some detail, actually, at the British Business Bank, and also makes reference to the European Investment Fund. And this is critical because one of the facts out of Brexit, the UK will no longer be a beneficiary, either a contributor to or a beneficiary from the European Investment Fund. So the UK government is going to replicate that in some shape or form sooner rather than later. So it's in place by the time Brexit actually occurs, and that's going to cost a lot of money. So the Treasury is going, there's no way we can afford to pay for all these different things. So I think the Treasury agenda is very much driven by cash. It's all about money. Now, in the review, there was specific criticism of capital schemes within the EIS, and it said that they were against the spirit of the legislation. A very large proportion of funds raised was actually for capital preservation schemes. We think they got their sums wrong because the Treasury were reading off 2-year-old data, and we, as an industry, have been at pains to explain to them that the situation has actually improved in the last year quite radically, and the number of capital preservation schemes has reduced substantially as a result of rule changes that were announced in 2015. So the Treasury doesn't know that because they're only reading off the data. The Treasury, it's quite clear they don't like giving relief to businesses that receive predictable income streams. Well, what is that? How do you define it? So obviously back in the renewable energy days, of the stream was the income from power generated, because from solar, for instance, that's highly predictable. It varies from year to year, only within a small 10% band. But renewable energy is no longer there, as you know, so predictable income streams probably can be defined as businesses which derive income possibly from supplying government agencies. So a company which has as its major customer or client a government agency like a local council, that could be deemed to be a predictable income stream. So like with many of these things, the actual definition and how you legislate against it is extremely complex. Another thing the Treasury is against is giving EIS relief away for funding businesses which could have easily found the funding from a different source, and they've actually put a prediction on that. They say that 40% of all the money being given away to EIS companies actually could have been funded from other means very easily and simply. So the Treasury is thinking it's wasting its money by a factor of 4 out of 10 or 40%. That's highly debatable, and I think a lot of caution needs to be applied. Now, the EIS Association responded by the due date, 22nd of September, and that response is available on the EISA website. So that's available for all to read, but just a very quick summary of it. Obviously, as an association, we're very anxious to cooperate closely with Treasury. We're basically saying we think that with the economy in such a delicate situation, now is not the time for major change. So caution should be applied, and major changes should, yes, we're happy to go along with those, but major changes should be considered later. We also make the point that this obsession with scale-up is, of course, you don't have any scale-ups without start-up. So you have to have a start-up before you can scale it up. So that's kind of obvious. We've also pointed out to the Treasury that recent rule changes, as I mentioned just now, have had a considerable effect, and that was the thing I think that they didn't realize. Specifically, there is a consultation going on media. So media is very much in the spotlight, if you'll pardon the pun. And the capital preservation schemes, which are used by most of the media funds, are really in focus at the moment, and we're not sure what's going to happen. I can talk to you more about those in a second. Look, as I said earlier, it's all about money, I think. And so what do the current schemes cost the Treasury? Well, 30% roughly of what VCTs are raising currently. That's 150 million a year. And 450 million in the case of EISs. So EIS is very much the big one. It's the most expensive one. I put in there business relief. That actually is probably, if it was all taken in 1 year, it would be costing much more than EISs. But of course, it fortunately is not all being taken in 1 year. It's only being paid out or suffered, if you like, in the year in which the investor dies. So that's spread across the next 25 years. So I don't think that's of concern to the Treasury. I think they're more concerned about literally and clawing back more money right now. The arguments we always make to the Treasury is that for the relief that the Treasury gives out to EIS businesses, they get back money from those businesses. They get back corporation tax receipts, income tax paid by the employees of the companies, and of course VAT. And we have actually here at Enterprise, we have several examples of businesses which we funded, and we're convinced that the Treasury is already in credit. So that's to say it paid out some £2 million in relief to fund these particular businesses, but it's already received more than that already in corporation tax, income tax, and VAT receipts. So that's the benefits, but at the moment the Treasury is hell-bent on cost reduction. Now, there are other trends which are, of course, occurring in the market. So I think there's a rise in capital gains. So there were very few capital gains in the period 2009 to 2015. I think that's now changing. Gains are coming out of the woodwork, and of course the lucky recipients of those gains are looking to shelter the impact of the tax by investing in EIS. EIS is also, as you know, increasingly being used as an alternative to pensions. Once the cap on pensions has been reached, advisors diverting their clients' funds into the EIS. There is also a quest for yield, as I describe it, in the current market with extremely low interest rates to be had from anything. Basically, people are looking for yield. They're very grateful to get back 6, 7, 8% yield, so they're definitely looking for the opportunity of positive returns. They are more and more aware of the need to avoid inheritance tax, and I think all the publicity that there's been in recent years about IHT, that's only served increased people's awareness of IHT and the importance of avoiding it. So it's sort of slightly backfired on the government. And then a final factor, of course, is that there's a spike currently going on in EIS exits. These are the exits from the renewable energy investments. They're all maturing round about now, and that's putting money back into the hands of investors who want to go back in again to re-shelter. So that's causing considerable pressure, which is driving up investment levels. So what could the government remember? Well, they could alter or amend the level of tax relief. They could reduce it from 30 to 25 or 20. There's a lot of experience we've had in this market. We believe 30 is absolutely the optimum level. If you reduce it to 20, the investors are no longer interested. 40 is probably too much. We had a couple of years of experimentation with VCTs at 40%, and then finally we settled down as an industry with 30% being given out to both VCT and EIS investors, and I think 30 is the optimum level. So I don't think they will, or they shouldn't, mess around with the level of tax relief. Some people are saying, are they going to change the term of the investment? Well, as you know, it's 5 years currently for VCTs, 3 for EISs. I don't think that's going to gain them any money, so I don't think that's in their sights. I don't think they'll bother with that. What they want to do is to claw back cash. How can they do that? Well, there's a very quick, easy target, and that's freeholds. And I think this has been highlighted by several people in the industry already. So an EIS business which has an underlying or underpinning freehold property, they are, I think, very possibly going to be for the chop. So that would include freehold pub companies, crematoria, and so on. So all the children's nurseries, etc. So all the businesses which have or rely on freehold properties as part of asset backing. Now, will they disqualify actual trades? And I think media is the one that is the most likely to be disqualified if they decide to disqualify a single trade. However, there's a number of different things they might do. They might actually reduce the relief for investment into media to half of what they're paying already. They might say, well, look, 70% or 50 to 70% of the investment is going into production credits and pre-sale contracts, which are semi or guaranteed to come back. We'll just cut the relief in half. We can't get involved in any more detail. It's too complicated. We'll give you half the relief. I think that's a possibility. They might put a red line through the whole thing. They might say they're still consulting, but that, as I said before, is unsatisfactory because we don't know when the consultation process will end. So media is definitely in the spotlight, so warning signals. Might they completely put a line through VCTs and EISs? I think that's really very unlikely. So they I think simply want to radically redirect money towards growth businesses. Growth capital is what they're looking at. This could impact on VCTs and not on EISs, as VCTs tend to invest in more mature businesses. So I think there could be possibly writing on the wall for VCTs in that respect. But On the EIS, as I say, I think they're looking for quick fixes, and freeholds and messing around with media would definitely save them a quantum of tax relief at a single hit. So that's, I think, what we need to look out for. So sort of semi-summing up now, I've got about 8 or 9 minutes to go. Pre-budget actions, well, that's fairly obvious, isn't it? You need to get all your VCT investments put away by 22nd of November, which I'm sure you're doing already. And so that's action number 2 is to put away your capital preservation investments, be they investments in freehold EIS businesses or investments in media funds which have a capital preservation structure. As I say, I'm sure they're going to be affected. It's just a question of how bad that effect will be. So I think you definitely need to plan on making those investments before the 22nd of November. IHT I mentioned just now, and I think it's complex, and I think it's not immediately in the government's sights because there's not an immediate cash return from messing around with business relief. However, I think they probably will at some point look at the trades. So I think, you know, money lending and invoicing and certain trades like that, I think they will decide that they're not really proper trades. I think that's one distinct possibility. So, but that may not be in this budget. Okay, so just a final word then on our product suite. So yes, we have a media fund. It's called Hindsight. Hindsight are incredibly experienced people. They've been doing media funding, primarily film and TV, for about the last 15 to 20 years. They've got a terrific track record, both with the EIS and outside of the EIS. And the EIS track record has produced an average return of 120. This fund is a diverse portfolio across film, TV, and games. 70% is capital preservation, so that means, I think you know how this works, 70% of investors' money is invested into productions, into the production credit and pre-sale element of the production. So that money comes back pretty quickly, usually within 9 to 12 months with a premium attached to it. And then is recycled again within the EIS company at least once and hopefully more than once, so maybe recycled twice, i.e. turned basically 3 times. We're targeting a mid case of 120. And that assumes a minimum of 2 rounds of investment within the EIS companies. There's no cap to the potential upside here, so it's unlimited or blue sky upside, which is important, I think. A lot of our rivals have got capped returns, or there's a very limited return. It's mainly a play on the tax relief, which is what irritates the Treasury. And as I said, Hindsight have got terrific track record. So that's just a brief word about Hindsight. Now, InBieber Leisure, this is our 5th season with InBieber, and a lot of you know the InBieber brand name. They are a partnership who invest in a series of EIS qualifying businesses that are in the London leisure and hospitality market, bar restaurants basically, each with a different concept. Each trading in different outlets in different parts of London. So the London leisure market is absolutely vast, highly resilient, and shows no signs of any let-up in its growth. InBieber are looking to achieve capital growth by supporting outstanding teams. So their reputation has really been established some time ago, and people in this industry looking for funding are desperate to get into bed with InBieber, and what they're trying to do is leverage off InBieber's property expertise and InBieber's incredible experience of operational management and control. So InBieber are the ultimate management controllers. If anything needs fixing, it gets fixed right away, so they really have got fantastic day-to-day control. And they're looking to enter into strategic partnerships with exceptional individuals who've got fresh and new appealing leisure concepts. Now, the outstanding track record of InBieber from 10 previous EIS exits is second to none. It's quite phenomenal. It's an average of 35% IRR return across 10 previous EIS exits. The London businesses consistently return an absolutely phenomenal return. We think we're on course to achieve a 2.5 to 3 times return from our next exits coming up. And the target return for the fund going forward is going to be a 2.5 times return. Third is our SEIS fund, which is investing, as I mentioned earlier, in food and drink products. Now, this is the first time there has been a food and drink SEIS fund. We work closely with the Startup Funding Club, who are our neighbours and asset managers in this sector, which is the startup sector. They're highly experienced. They've invested many millions in tons of companies, so they're very used to the whole ecosystem of mentoring, introducing people who can be coaches and mentors to these businesses, low-cost advisory services from accountants and lawyers, etc. The fund also has the support of major retailers, which is really interesting. So major retailers like Tesco, Waitrose, etc. spotted the opportunity some years ago actually to sponsor startup food and drink products, and they do that by offering free shelf space or trialing products in certain stores, because they're desperate to beat off their competition from the likes of Amazon, etc., and to establish exclusivity with new and exciting brands appealing to new audiences. So that's very much the rationale for that. JC Deco, the outdoor advertisers, are also sponsors, and they offer free advertising space. I've put here a generous range of SEIS tax benefits, so I'm sure you all know what those are, but I think they're very much skewed in favour of the investor. So the investor gets freedom from CGT on the profits, and if he makes losses, he or she get loss relief. So it's very favourably skewed in favour of the investors. And finally, last but not least, we have our business relief product, which we promote in collaboration with Guinness Asset Management. The asset managers are Guinness. They've been in renewable energy and in infrastructure investment for quite a long time now. They've got an absolutely superb track record, wonderful reputation. Now this is interesting, this particular fund, because it has a very specific focus, and that's not just solar, but actually roof-mounted solar projects. So we're talking about solar panels on commercial and domestic rooftops, but primarily commercial. This is where you go along to a factory owner or a warehouse owner and you say, I can reduce your power bills by putting solar panels on your roof. Now, there are no grid connection charges because the factory is already connected to the grid. There's no planning issues or delays. It's not like being out in the country where you have to actually connect to the grid. So this is an absolutely super niche that Guinness have found here, and it's already doing very well. So the target return for this investment is 5% per annum net of fees. This last 12 months, they have achieved actually 7.5%. So way ahead of the target. So that's really encouraging. Of course, these are predictable income streams because it's solar. How can people get in and out? Well, it's very simple. This is a very simple, logical offer. We have what we call quarterly liquidity events based on independent valuation every quarter, and investors can either take ad hoc redemptions, or they can arrange redemptions on an ongoing regular basis every quarter, whatever they're looking for, whether the client is looking for regular income, one-off occasional income, or no income at all. Now, I've left the best point to the end. There are no upfront fees for investors who come through advisors, and very low ongoing costs. So this is really an extremely low-cost operation, very appealing focus on just solar rooftop, and an absolutely first-class management team. So we think it's an extremely strong offer. So there we are. Let me know now if you've got any questions. My colleague is right next to me and is probably going to be giving me the questions in a moment, which I can try and answer. So I hope that was helpful, and please send us in your questions, and I'm happy to answer them for the next 5 or 10 minutes. Any more questions on either the budget, what we think is going to happen in the budget, or on our products, that's to say the Hindsight Media, InBieber Leisure, Epicure, SEIS, or Guinness Solar Rooftop? So let me know if you have any questions. I'm happy to take them. So while we're waiting for more questions, I don't know whether there's anything else I can add to what I've already said. The budget is on the 22nd of November. We're halfway between the Patient Capital Review responses closing date on the 22nd of September and the budget date on the 22nd of November, both 22nd somewhat spookily, and so we're nearly halfway through that period. And as I said, we are still continuing a dialogue with the Treasury. Some people take the view the Treasury's already made up its mind. It's too late. They're dead set on making certain radical changes which will produce a cost benefit to the Treasury. Other people think the door is still open. It's quite difficult to tell which way it's going. And we will see on the 22nd of November. I'm wondering whether I can tell you about any other trends. As I said earlier on, I think freeholds are definitely very likely to be chopped. So that would be pub companies, children's nursery companies, crematoria, and so on. I've now got a question from somebody. Aha, Marcus Cole, in regards to the implications on the media market, how strongly do you believe the regulation inflow will be? Well, I think very strong, Marcus, is the answer. I think they are definitely looking to do something. It's just a question of what they might do. So they might simply say, this is too complicated to legislate, we'll give you half the tax relief. Or they might say, we'll carry on consulting. Or they might say, the whole of media is gone. I think that's less likely. So there's a number of different options they have, but they're definitely going to do something. I mean, I guarantee. And so how radical that will be, we don't know. We'll just have to wait and see. So I hope that answers your question. Any more questions about changes to media? So just to talk a little bit more about the details. So 70% capital preservation in a media structure, that means 70% of investment is invested in the production credit or pre-sale element of the production investment, and that comes back. So it really effectively is cash flowing, those two things. So then the production house will, when the production is completed, they will get the production credit from the government, or whichever government it is. Doesn't have to be the UK. If it's a production which has been shot in an overseas territory, they will get from the overseas territory. It's very important to realise that. And then there's the pre-sale. So what is really difficult is that nobody in their right mind invests in a production if there isn't a pre-sale. So you know, if somebody comes to me and invites me to invest in a production, I'm going to say, who are the stars? Who's the director? What are the pre-sales? And they usually say, well, we've already pre-sold it to the UK and the US for X million. you know, it's all a question of what recoupment position I'm going to be in, how much the rest of the world outside of the US and the UK is going to produce in profit, and that really informs my investment decision. So it's very hard for the Treasury to say you can't invest in a production or in a company that's investing in productions where there are pre-sales in place, because every investment in a production has pre-sales in place. So it's just a question of when those pre-sales are entered into, I suppose. That could be a defining point. So they could say you can't invest in a production company which is investing in a production where there are already pre-sale contracts in place, which would simply mean that you would delay the timing of your investment until the day after you'd delay the signing of the pre-sale contract until the day after you'd made the investment. So it's really very difficult to legislate against this. That's why I'm nervous that the government might say, right, scrap the whole thing, or they might just say, judgment of Solomon, I can't tell which is the bad part and which is the good part, I'll cut it down the middle. Any of these things could happen. So I'm happy to take any more questions if there are any more. Any further questions from anybody? Still happy to take them. Any more questions? So I'll keep this open for a few more minutes in case any more people want to ask any more questions. Otherwise, we'll close down in a couple of minutes' time. So thank you for your time and attention this afternoon. Please be in touch if you would like any further clarification or help. I've got another question. Marcus. Marcus says, thank you for your response. In addition, is it likely that retrospective regulation may occur on asset-backed type investments formed under previous regulation? Marcus, I think it's really quite unlikely. Retrospective legislation is extremely unfair and it's not illegal, unfortunately, but I think it's highly unlikely. I think the government is very anxious to appear to be fair and reasonable. So I think retrospective legislation is out. They did go in for a bit of retrospective legislation back in the days when they were trying to clamp down on film partnership schemes. I don't think they will do it in this instance. So I would be very surprised if there was any retrospective legislation. I hope that's helpful. So to sum up then, you need to make your investments in media, I would say, before the 22nd of November. That is if you like media and if it's something you're intended to invest in. Okay, any more questions, or I'll be done. I think we're probably finished. As far as I can tell, there aren't many people left on the call. So again, thank you to everybody for your time this afternoon, for watching, and please be in touch if you have anything further you'd like to ask, and please also be in touch with your investment. That would be even better. So thank you very much, everybody. Bye-bye.